Hello, this is Nick with you, and we are going to go over the week of May 2nd. So, this week marks the first 100 days of Trump administration, and it has been chaotic for sure, but putting tariffs aside, the energy prices, the fact that they're coming down and they're the first part of the economy, is gonna really help boost the activity, as we are gonna see over this report. Now, before we get into our report, I want to go over some house cleaning here. We believe that over the long term, China, because it's a pure competitor, because of its population and its growing GDP per capita, the US is gonna move on to contain them. We are not gonna go much into detail, but we use theories, and theories try to explain the reality to some extent. Offensive realism is the theory that we use here, and if we consider that it works 80% of the time, and if the US moves to contain China, tariffs will remain at an elevated level for China. Okay, moving on. Okay, coming to the money market rates, like the rates went up a little bit, but all in all, they stayed flat on the money market side. However, on the capital market side, we are seeing the rates going up, and as you can see, the 30-year is where it started the year at, and the 20-year is there also. So the rates are going up for sure, and the market is pricing, I believe, inflation in the longer term, and the fact that the US CDS spreads are going up, you can add default spread here as well. I don't like to go over into that territory that US debt is not default free, but it's gonna make things a bit more complicated, but it's okay. At least we live in this real world, and we are gonna analyze it as such. Otherwise, we are gonna have overvaluation or undervaluation based on the asset that we're valuing. Okay, and the market is slope, money market compared to capital market inverted, and otherwise we have a normal curve. So I believe, like, if it wasn't for the independence of Fed and that issue, going to the prices, you are going to see that the Fed, I believe, has the permission to cut interest rates. Okay, real yields were up. As I said, CDS spreads are going up. So let's see where that's gonna take us. Mortgage rates still sticky. They are not coming down for sure. It takes Federal Reserve cutting rates, that's one. But then again, if we are gonna have inflation in the longer term and the prospect of a riskier US sovereign debt, then you are gonna have a higher mortgage rates in the longer term. So when it comes to real estate analysis, you need to incorporate that to your analysis as well. Break-even rates flat all in all, and Fed balance sheet down, and reverse repo rate up, which shows the money that the banks had parked with the Federal Reserve. So they're offsetting each other to some extent. Price levels. So for April, CPI was down a bit, but not that much. But more interestingly is the PCE and core PCE. Like you had an increase of 11 basis point for April estimates from last week. Let's see where they're going to land on. Commodity prices. Gasoline down. Crude oil down. And copper down as well. Natural gas up, but like also you're moving to the summer season as well, but like it's gonna stay elevated because of the uh, all the energy, all the tech companies and their need for computation. And computation, when it comes to artificial intelligence and training the system, it's energy intensive. So I believe that like the natural gas prices are going to remain elevated for the foreseeable future. PCE came flat for March, and as I said, like 2.3 year over year and 2.6% for the core was a permission for Federal Reserve to cut. But like with the rhetoric coming out of White House, if they cut right now, the market, there are going to be voices from the market that they're going to say that they were influenced by the White House. So I believe they are going to remain the course right now and stay the course. But like in the next meeting, they're going to cut for sure. PMI manufacturing prices up. And this is a survey, but one thing about this is that the prices are going up, yes, for sure, because we have tariffs in place. But if you want to restructure the economy in a meaningful way, you need capital investment. And capital investment, for that, you need lower rates. So, like if you have higher rates for longer, and if the market waits for the rates to drop in order to do their investments, then you're gonna have a recession. So there's a trade-off that Federal Reserve needs to be careful about. Otherwise, sure, the independence of Fed is important, but like if Fed is always late to the party, or if it could not mitigate the inflation like it didn't mitigate it in 2022, and then inflation were rampant, and then like moving to this, if they are a bit slow to cut the rates, because it's gonna take time for it to affect the economy. And as I said, if they are slow to do it and we go into a recession, like after some of these like booms and busts, like markets and the constituents are gonna question the credibility of Federal Reserve to smooth out the business cycles. Government credit. If you were in the TLT or like in 20-year plus, it wasn't a good week for sure. And I believe like moving forward, like everyone coming to the year, we're expecting like the lower deficits, but it didn't materialize that much. The best that the US government can do as of now is to keep expenditure under control and increase revenue and the tax base. So right now, I don't believe that they're on this path, and the market doesn't believe that. So you see the interest rate, especially on the longer end of the curve, is going up. And having that, I'm gonna stay out of the capital market, especially 10 to 20, and stay in the 1 to 5. And the tips yields. Tips now are a good bet. They're a safe bet because they're going to compensate you for inflation. So if you move into a stagflationary environment, let's say 1 to 3 years, if you move into a stagflationary environment, you're going to get a coupon, you're going to have the payment that is due for inflation, but also you're going to see the positive side of the Federal Reserve cutting the rates. So at the same time, you're gonna have a boost to the TIPS return. One coming from inflation, and the other one coming from the fact that there are gonna be cuts in a stagflationary environment. So TIPS, I think they are not really paid attention to. So I think they need more attention, and maybe we open a section just to analyze TIPS and how to enter this part of the market. Corporate credit. So as you can see, the triple C is coming down a bit, but it is higher than it started the year. Otherwise, the corporate credit for the investment grade and even like double B and B, they are right now higher where they started the year. And it's gonna make it more expensive for companies to raise funds. And also you have the fact that they need to keep their, sorry for that, they need to keep their debt to equity ratio in the same ballpark. And considering that their equity values are falling so rapidly, I believe you're gonna see lower issuance for debt in the future, and that might help with the spreads, that's for sure. But then again, I believe like they need to refinance some of their debt, and with this elevated option adjusted spreads, it's gonna be a bit hard for them. And the fact that the interest rates themselves are going up. So let's see what's gonna happen in this segment of the market. So I believe like the cost of debt is gonna go up. So we need to pay more attention to it and bring it to our analysis as well. Okay, coming to the fiscal side. Deficit down 1.72% year over year, year to date. And as you can see, we are seeing meaningful jump in the tariffs and the revenue that they're generating, and we are up around $14 billion. Let's see what the deals are gonna do. I believe, like as I said, the China tariffs are gonna remain high, but like the problem is that at these high levels, there essentially will be no more trade, and you are not gonna see so much revenue coming from there. But in the short term, it's gonna boost the rhetoric from White House that because we have revenue from tariffs, the Congress can go and cut the rates. I don't say like it's really that defining, but then it's gonna help them with their rhetoric and like how to pursue the Congress to do so. Total spending was up, and total non-interest spending was also up, but receipts growth at a faster pace, which is very important here. Let's see if they can keep this momentum going to the future. Okay, moving to the labor conditions. So I'm just gonna start by the fact that the establishment payrolls report came at 177,000 new jobs, which is good, and it beat the estimates. The participation rate went up. The ADP report showed 62,000 new added jobs in the private sector, but at the same time, you are seeing the initial claims going up and continued claims also going up. Yes, we started the year with 205,000 initial claims. Now we are at 241,000. As of now, if it doesn't go higher than this, it suggests a restructuring. But it's interesting, when I was going over the payrolls, so much of it was in transportation and in inventories and goods and manufacturing. And you had a high level of imports this month, which might suggest that they needed these people in order to move all these goods to the warehouses. But, and like considering this, I believe like next month report is going to be more important. So I'm not bullish as of now, because the initial claims were up, continued claims were up, and the fact that the establishment payrolls were up was because of transportation and like inventories. So this doesn't flash a green light to me in order to enter the market with a risk on approach. So we need to wait a bit more. Okay, going to consumer and sales, most of the indicators haven't changed, and like we didn't get the results for April as of now, but ISM manufacturing came and it was down a bit, but not by that much. But remember, US economy is more services oriented as opposed to manufacturing. Okay, going to the PMI itself, the services is gonna come next week, but the manufacturing, new orders up, interesting. Employment up, but like again in the in the contraction environment, but it was up. New export orders down. So I would be careful entering into positions that have companies that are exposed to international trade, because when you see reciprocal tariffs and you see backlash from the consumers, then your sales are going to drop. So I would stay out of companies that have global footprint when it comes to goods, but not really in services, because services, it's more about the brand, and like especially when it comes to Mac 7 and like other big tech, they're like so sticky that it's not really easy to switch between like uh, American services to like local services. For example, when it comes to cars, or when it comes to, let's say, clothing, you can switch easily, but not when it comes to, for example, let's say Instagram. That's for sure. Moving on, this week, a small outperformed the large, and the S&P was up 2.92%. Year to date, it's down 3.1%. And year over year, S&P is up 12%. But this week, we saw a bit more risk on approach, and the small companies have gained a bit more than their large counterpart. And I believe when you have a regime change, you need companies that can withstand this titanic plate shift. Some argue that like small companies have more exposure to to the United States, and when you have tariffs, they're gonna be in a better position, but not if you get a recession, and not if you have like supply chains that are all over the place, because they could be small, but they could be importing much of their needed inventories and goods and services. But large companies, on the other hand, let's say even if they have global footprint, they can do divestitures, and also they can manage their supply chains in a way as to avoid tariffs totally and minimize their impact. So I believe like large are gonna outperform for the foreseeable future, and that's gonna be a trend that you needs more attention. Sector's performance. Oil was down 7%, but the energy select sector was down only 0.4%. You have like other companies like integrated and like those companies in your select sector. But then again, the fact you and also you had the VIX coming down. And as a rough estimate for the price, you have earnings on top and you have cost of capital in the denominator. VIX went down, that's for sure, but like oil was down 7%. And I'm not sure why the energy sector went that up. Maybe it could be a re-evaluation of the previous repricing. Maybe market reacted too much. And the fact that OPEC had signaled that we are gonna increase production and we're fine with prolonged lower oil prices, it's not a good indicator for the energy sector, at least in the US. And the winner of this month was the industrials. And I believe for the foreseeable future, it's gonna stay the same way. Because if you're gonna have restructuring and if you're gonna have manufacturing move back to the US, you're gonna have your industrials go up. The winner in the industry performance sector, the winner this week, I would say, was entertainment and hotels and resorts and cruise lines. And the main reason was because of airlines. Jets is an interesting ETF to keep an eye on. And I would say that it's an oil story because energy prices are coming down, and much of the, especially when it comes to airlines, much of the costs comes from cost of energy. So it's natural to see if you're gonna have a prolonged oil slump, then you're gonna have your airlines and your um, like hotels and resorts industry perform better because you need to move people in order to get them to hotels and resorts. And if you have the airlines down, oil prices down, it's going to be easier to do it. And utilities, and sorry, when it comes to insurance, no matter what happens in the market, they're up. Weekly, they're up. Year to date, they're up. And year over year, they are up. Okay, and these are some ETFs pertaining to the sectors. As I said, insurance. I remain overweight on insurance because no matter what happens with the economy, if there is a recession, if there is a boom, you're gonna have your insurance stay the course, and people are gonna go and get their insurance no matter what happens. At least most of them are gonna do. So insurance is a good pocket of resistance in this market, and airlines. If you believe that oil prices are going to remain lower for the foreseeable future, it's a good play. But also, you need to pay attention that the US is tightening its travel policy, and like countries like Canada and like other countries are putting travel advisory on the United States, and you're gonna have a backlash from the tourists. So you need to value that carefully, not just go into that sector because of lower oil price. But that's for sure is going to help. Let's say if you have lower prices for the foreseeable future, and after 4 years you get another administration in the US which is not that belligerent when it comes to its rhetoric, then airlines are set to really benefit from this. Okay, going to the commodities. Energy prices were down week over week. Coal was up a bit, but year over year it remains lower by 30%. And let's say, given this deregulation, let's see if it's going to increase its production and its use. And uranium is up, maybe because of the situation with the Russians. There are talk about that Russians are advancing so much, and at this point, Russians might not want to enter into agreement with the United States. So, if you have a delayed agreement between Russia and Ukraine, then you're gonna see higher uranium prices for at least for some time. Going to metals, gold was down a bit, and the reason was because there wasn't that much risky rhetoric coming out of White House. Copper is up, and let's see, it's year over year it's up, and it remains elevated. And yes, you are gonna have like some tariffs in place, and it's gonna lower the prospects for growth. But then, because countries like China, they value energy security. And energy is the first part of the economy. And China doesn't have like natural resources like oil and gas. And as you can, if you read the reports, they're really going heavy on clean energy. Not because they're like advocating for like climate change or those sort of things, because in the case of an embargo or oil embargo on them, or like these kind of stories, clean energy is gonna come to the rescue. So copper, I believe, is going to profit from this. And also, if you're gonna have a lower dollar in the foreseeable future, then copper is gonna go up for sure. Going to your agriculture was down a bit, except for soybeans, and because like the rhetoric on China is changing, and you might get a lower tariffs on them, as they put it. But food inflation remains a problem. Like energy prices are down, but food inflation is there. Like coffee prices are up, and I believe like either you get innovation, or either like lower energy prices are gonna help with the production of more food and like agriculture products. And live cattle is going up, and I was wondering last week, why is it like always going up week over week, year to date, and year over year? And as it seems, a report by Bloomberg that there is a new parasite in circulation that might pose a danger to the supply chain of live cattle and like cattle in general. Okay, asset classes. The outperform EMX China outperformed this week, and WTI crude oil underperformed 7%. That's a high number. You had your Bloomberg Commodity Index also down, so commodities were down this week for sure. And Europe did better than S&P. And considering that Germany has fiscal room to increase its spending, you're gonna see a boost in the German economy if they stay the course and if they reach a deal with the United States. And lower energy prices is really beneficial to the European economies because Europe is a net importer of oil and gas, and that's really gonna help them. Here, risk levels. You can see the current week, the VIX futures are flattening. So I believe like you are gonna see an elevated level of VIX index at least for the next year, and like because these tariffs are not gonna be solved in like a week or two. At least they're gonna take months. And like you had the VIX and like all the other implied volatility indexes come down from the prior week, except for the oil implied volatility. The reason? And I believe like there was a big explosion in Iran, and considering all of these facts, and they canceled the next round of negotiations, putting all this together shows an increased level of tenseness, not escalation, because they are not in a conflict with each other directly, but the tenseness is increasing. And if it turns out to be an escalatory situation, that's not going to be helpful for all the other risk levels. So right now, only OVX is up, but if it doesn't come down, you're gonna see other parts of the market are gonna react. Also, you had OVX go up because the energy prices moved so dramatically this week, and because of the word of OPEC that they put out, especially the Saudis, that we are okay with lower oil prices. So that's one reason. But then again, Iran is the other reason. Okay, moving to oil demand and supply. Okay, ONG producers, oil and gas producers all over the world except for Russia and Saudi Arabia and like UAE, they were up. The reason for that, you had the VIX coming down, that helped, and also because you're gonna see an increase in production by some countries. So, but like the fact that we have a 7% drop in oil prices, I believe like this week, if it doesn't bounce back, it's gonna be ugly for oil and gas producers index. Oil and gas for Russia dropped. Why? Talk of new sanctions on Russian fleets. So trying to target the Russian oil and gas sector specifically. But I believe like in the longer run, it's not going to have a real impact on the flow of oil and gas. Aramco down. Again, even though they're going to increase their production, the risk from Iran is really elevated. And you know, the way that this works is that, so you have the Saudis, you have the Iran, and you have the US. So you have the Iran and the US in talks in order to reach a nuclear negotiation, in order for the US to not attack the Iranian nuclear facilities. The US says if we don't reach a deal soon enough, we are gonna attack the facilities, and the Iranians, considering the fact that they are no match for the US military, they are gonna go or they are gonna go after the oil and gas infrastructure in the Middle East and try to cause chaos. And that's the reason that a negotiation between the US and Iran is really important. One other fact that needs more attention is everyone in the market is saying that Saudi said we are okay with lower oil prices because they're tired of like doing cuts after cuts and not seeing the oil prices go up. They said that. Before that, they said the reason that the Saudis are doing production hike is because in OPEC is because to say like the countries that are like cheating their way, they are not really cheating and they are really like sticking to their quotas or those kind of things. But the real reason I believe here to some extent is that the Saudis want to force the Iranians to the table and to win favors from the Americans in order to not attack the Iranian nuclear facilities. And if the Iranians have lower revenue from oil and you have the US um, benefiting from that lower oil prices, you're going to have both of them going to be more willingness to negotiate with each other. And Saudis really want them to negotiate because otherwise, if they don't negotiate with each other, Saudi Arabia's oil facilities might be targeted by the Iranians, and that's gonna cause a havoc in the markets, and especially to the goals of the Saudi Arabia. Going to the EIA report, starting from the crude oil production, it remained flat at 13.5 million barrels a day. Inventories down. Refinery input was up, and the capacity utilization was up, and even year to year it was up. Gasoline supply was down a bit from last week, but it was higher than previous year, so that's a good indicator here. Production was down, and you had the stock go down. So right now we're in a good position. I'm not seeing that much of a weakness, but the story in distillate is a bit different. The supply is down year over year, and distillate has industrial usage more than consumer usage. Its production flat week over week and up year over year, and its stock is going up. So we need to keep an eye on distillate and gasoline, and then see where the crude oil production is going to be at. So considering this week's data, I believe that we remain in a good spot. The US consumer, even though the soft data shows pockets of weakness, but the hard data says a different story, and markets have rebounded from the April crisis, that they can put it, or maybe like they're like repricing or like rebalancing their portfolios. Moving forward, I believe like the fact that the negotiations between the Iran and the United States have went south is an important thing to keep an eye on. which is really important, to be honest with you, because if things go south in Middle East, energy prices are gonna go shoot up, and if energy prices shoot up, then you are gonna have a recession for sure, a prolonged recession. It's interesting. Out of the past 10 recessions, 8 of them were preceded by increase in oil prices. So let's see if the rhetoric is gonna change this week or not. Have a good week. See you next week.